Question 761. One of the main reasons for creating the secondary mortgage market was to A. Establish an auction network for junior deeds of trust. B. Maintain state oversight of the mortgage market. C. Provide balance between regions with a lack of mortgage funds and those with an overabundance of funds. D. Enable investors to earn a high return. Correct answer is C. Provide balance between regions with a lack of mortgage funds and those with an overabundance of funds. Before the secondary market, historically, local banks and thrifts, like savings and loans, were the primary source of mortgage funds. If a region had many savers but few borrowers, they might have an overabundance of funds. Conversely, rapidly growing regions might have a lack of mortgage funds, because local deposits couldn't keep up with housing demand. This led to uneven interest rates and limited access to mortgages. The secondary mortgage market, with key players like Fannie Mae and Freddie Mac, allows primary lenders, the banks that originate loans, to sell their mortgages to investors. This process replenishes the lender's capital so they can make more new loans. The secondary mortgage market balances the demand and supply of mortgage capital. It achieves this by pooling mortgages from various regions. This process ensures funds are consistently available nationwide at more uniform rates. The secondary mortgage market is largely federal in its creation and regulation, e.g., HUD, GSEs, aiming for national stability and liquidity, not primarily state oversight. State regulation exists but is separate from the market's fundamental purpose. Investors do look for returns, and the secondary market offers investment opportunities through things like mortgage-backed securities. However, its main purpose was to bolster housing finance and ensure liquidity for lenders. This ultimately benefits borrowers and helps stabilize the entire housing market. Investor returns are a consequence and incentive within the system, not its foundational purpose. Question 762. An ALTA policy of title insurance does not insure against A. Forgery. B. Defects in the chain of title. C. Zoning changes. D. Parties in possession. Correct answer is C. Zoning changes. An ALTA, American Land Title Association, policy of title insurance provides extended coverage policy, often protecting against off-record matters that a public record search might not reveal. However, no title insurance policy, including an ALTA policy, insures against everything. Title insurance covers title defects existing as of the date of the policy. It does not cover future events or certain government regulations. An ALTA may policy including 1. Forged documents. Forgeries in the chain of title. 2. Defects in the chain of title. Errors or omissions in the recorded documents affecting the property's ownership. 3. Rights of third parties. Claims or interests held by others that could affect the property's title. A zoning change affects the property's use or value. It's typically not covered by the title insurance. It's important to note that specific coverage may vary depending on the terms of the ALTA policy and any additional endorsements purchased. Question 763. Which of the following is a characteristic of a freehold estate? A. Always acquired with no payment necessary. B. Always acquired through some kind of easement. C. Of uncertain duration. D. Both A and C. Correct answer is C. Of uncertain duration. A freehold estate is an ownership interest in real property that is characterized by having an indefinite or uncertain duration. The exact time when the estate will end is not fixed or determinable at the time it's created. Most freehold estates, like buying a home, fee simple, are acquired through significant payment. While some might be inherited or gifted, the acquisition method isn't a defining characteristic of all freehold estates. An easement is a right to use someone else's land for a specific purpose, like a right-of-way. It is not an ownership interest, a freehold estate, itself, nor is it the way freehold estates are typically acquired. fee simple estate is the most common type of freehold estate. It lasts indefinitely and can be inherited. Its termination is uncertain. Life estate is another type of freehold estate. In contrast, a leasehold estate, like a tenancy for years, has a definite, fixed duration. Question 764. Percy submitted an offer to purchase a property accompanied by a deposit. The offer contained a clause that said the offer was contingent upon Percy obtaining a loan for $100,000 payable over 20 years, at an interest rate of less than 8%. Which of the following is correct? A. If the loan proves unavailable, then Percy and the seller may agree to change the purchase price. B. If the only loan available is less than $100,000, then Percy must go ahead with the purchase anyway. C. If the loan proves unavailable, then Percy can withdraw his offer but lose his deposit. D. If the loan proves unavailable, then Percy can withdraw his offer and get his deposit back. Correct answer is D. If the loan proves unavailable, then Percy can withdraw his offer and get his deposit back. A contingency clause is designed to protect a party to the contract from harm in the event that a specific event or circumstance does or does not occur. The clause in Percy's offer is a financing contingency. This means the offer to purchase is conditional upon Percy securing a loan with specific terms: $100,000, 20 years, less than 8% interest. If that amount is unavailable, the condition isn't met. While they may agree to renegotiate, the contingency itself doesn't obligate them to. Percy is not bound to proceed if the loan isn't met. The purpose of a financing contingency is to protect the buyer's deposit. If the buyer makes a good faith effort to obtain the specified financing and it's genuinely unavailable, the contingency allows them to back out of the deal without forfeiting their deposit. Question 765. Which of the following is an ad valorem tax? A. Use tax. B. Real estate tax. C. Value added tax, VAT. D. Income tax. Correct answer is B. Real estate tax. An ad valorem tax is a tax whose amount is based on the value of a transaction or property. The Latin phrase, ad valorem, literally means, according to value. A use tax is a tax on the storage, use, or consumption of a taxable item or service on which no sales tax has been paid. It's a complement to sales tax and is typically a percentage of the purchase price, making it ad valorem. However, it's often levied after the initial transaction, not directly on the value as the primary assessment. Real estate tax, also known as property tax. This is a tax levied on real property, land and buildings, as a percentage of its assessed value. This perfectly fits the definition of an ad valorem tax, as the tax amount directly correlates with the property's value. A VAT is a consumption tax levied on goods and services at each stage of production or distribution where value is added. While it is ultimately borne by the end consumer and is a percentage of the value added at each stage, it's a specific type of consumption tax. However, it is an ad valorem tax in nature because it's based on value. Income tax is a tax imposed on individuals or entities based on the income or profits they earn. The tax rate can be progressive, meaning higher income pays a higher percentage. The tax itself is on the income earned, not directly on the value of an asset or transaction in the same way as a property tax. Out of the given options, real estate tax is the most classic and direct example of an ad valorem tax, where the entire tax is directly calculated as a percentage of the assessed value of the property. While VAT is also ad valorem in principle, real estate tax is a clearer and more universally recognized example of an ad valorem tax in this context. Therefore, the most accurate answer is B. Real estate tax. Question 766. Sellers can extend credit to a buyer through use of A deed, B. Option, C. Land contract, D. Easement. Correct answer is C. Land contract. A deed is a legal document that transfers ownership, title, of real property from one party to another. It is the instrument of conveyance, not a method of extending credit. An option grants a potential buyer the right to buy a property within a set time frame. However, it doesn't obligate them to complete the purchase. This arrangement typically doesn't involve the seller providing financing for the purchase price during the option period. An easement is a legal right to use another's land for a specific purpose, e.g., a driveway across a neighbor's property. It has nothing to do with extending credit for the purchase of the property itself. Land contract, also known as a contract for deed, installment land contract, or real estate contract. This is a specific type of seller financing where the seller retains legal title to the property while the buyer takes possession and makes installment payments. The buyer gets equitable title, the right to eventually gain full ownership. Only when the buyer has paid the full purchase price, or a significant portion, does the seller convey legal title to the buyer via deed. This directly involves the seller extending credit. Question 767. The essential elements of a valid escrow is a binding agreement between the buyer and seller, b. recording of the escrow agreement, c. delivery of something of value to a neutral third party, d. both A and C. Correct answer is D. Both A and C. While recording the escrow agreement can be helpful for creating a public record, it's not an essential element of a valid escrow. The agreement can be valid even if it's not recorded. An essential element of a valid escrow is a binding agreement between the buyer and seller, along with the delivery of something of value to a neutral third party. The Bureau of Real Estate notes that what is being delivered can be in the form of money, written instruments, documents, personal property, or other things of value, to be held until the happening of specified events or the performance of described conditions in the escrow agreement. This creates a legally binding agreement that outlines the terms of the transaction and ensures that the funds and documents are held securely until the conditions of the sale are met. Therefore, both a binding agreement between the buyer and seller and the delivery of something of value to a neutral third party are essential elements of a valid escrow. Question 768. Which of the following is true regarding the preparation of an offer? A. A broker is not responsible for any negligence in filling out an offer form. B. A broker can offer limited legal advice regarding a clause in the offer. C. A broker cannot fill out pre-printed offer forms. D. The buyer can compose his own offer. Correct answer is D. The buyer can compose his own offer. Real estate brokers and agents owe a fiduciary duty to their clients and are expected to exercise reasonable care and skill. They can be held responsible for negligence, errors, or omissions in preparing documents like offer forms that result in harm to their clients. Real estate brokers and agents are not licensed to practice law and generally cannot provide legal advice. They can explain the meaning of pre-printed clauses as understood in common real estate practice. But they cannot interpret them legally, advise on their legal implications, or draft specialized legal clauses. Doing so could constitute the unauthorized practice of law, which has severe penalties. If legal advice is needed, they must advise their client to consult an attorney. This is a common pitfall for real estate licensees. Brokers and agents routinely fill out pre-printed offer forms, like those provided by the California Association of Realtors, as part of their daily business. These forms are typically prepared by attorneys for general use in real estate transactions. Agents fill in the blanks with the specific terms of the deal, price, dates, contingencies, parties' names, etc. While it's highly advisable for a buyer to have legal counsel or a real estate agent assist them, a buyer, or any party to a contract, has the legal right to draft their own offer. If they do, they bear the responsibility for its legal sufficiency and any errors. Many, for sale by owner, FSBO, transactions involve buyers and/or sellers drafting their own agreements or using online templates, often with attorney review. Although a buyer can compose his own offer, his broker will still be negligent for any material errors it contains. Question 769. If a first trust deed contains a provision referring to a previously recorded instrument, that likely refers to A. Fictitious trust deed, B. Acceleration clause, C. Subordination clause, D. None of the above. Correct answer is A. Fictitious trust deed. An acceleration clause is a provision within a trust deed, or the promissory note it secures, not a separate instrument than a trust deed. While a fictitious trust deed would contain an acceleration clause, the reference isn't to the clause itself but to the entire document where that clause resides. A subordination clause is also a provision within a trust deed, or a separate agreement, that changes the priority of liens. It's not a standalone previously recorded instrument that a first trust deed would generically refer to in this manner. The term fictitious deed of trust is a modern legal term referring to a general deed of trust recordable in every California county, containing all the standard provisions normally used in actual transactions. The pre-recorded fictitious deed is incorporated by reference in each short-form instrument prepared for a particular transaction. In real estate, particularly in California, it's common practice to use fictitious trust deeds, also called master deeds of trust. A fictitious trust deed is a long document containing all the standard clauses, terms, and conditions that are common to many trust deeds, e.g., provisions for default, insurance, taxes, due on sale clauses, etc. It is recorded in the county where properties are located, but it does not refer to any specific loan or property. When a new loan is made and a first trust deed is created for a specific property, the actual recorded trust deed for that specific transaction will be a much shorter document. It will often incorporate by reference the lengthy terms of a previously recorded fictitious trust deed. This saves recording costs and time by not having to print the full boilerplate language for every single loan. Question 770. A tenant agrees to pay a predetermined rent of $1,000 per month, while the landlord will pay other expenses such as taxes, maintenance and insurance. This type of lease is called A. Graduated lease, B. Percentage lease, C. Fixed lease, D. Net lease. Correct answer is C. Fixed lease. Graduated lease is a lease where the rent payments increase at specified intervals over the term of the lease. This doesn't match the description of a predetermined, flat monthly rent. In a percentage lease, the tenant pays a base rent plus a percentage of their gross sales. This type of lease is common in retail properties. This doesn't match the scenario. In a net lease, the tenant pays a base rent plus some or all of the property's operating expenses, like property taxes, insurance, and maintenance. This is the opposite of the scenario described, where the landlord pays these expenses. In a fixed lease, also commonly called a gross lease, the tenant pays a predetermined, set amount of rent, in this case, $1,000 per month. The landlord is responsible for paying all or most of the property's operating expenses, such as property taxes, insurance, maintenance, and utilities. This matches the scenario given.